Hello, everyone, and welcome back to the second part of episode 26 of JustDario Cigar Time. Today, we're not only going to pick up right where we left off on Friday, but considering Moody's decision to downgrade the US credit rating after markets closed for the weekend last Friday, I will also share my view on the potential developments markets will have to deal with. If you missed part one, we talked tariffs, the US-China truce, and why the market's riding high that might hand by June 25th, the day of Nvidia's annual general shareholders meeting. May 28th, 2025 is circle red on my calendar. That's when Nvidia, the poster child of the AI boom, releases its Q1 2025 earnings. CEO Jensen Huang is going to have a lot of explaining to do. Investors are salivating for bullish news. But I'm here to tell you, the numbers aren't looking pretty. Unless Jensen pulls his usual trick of spinning a yarn, there is not much meat on this bone. Let's rewind to April 15, when markets were still caught in the tariff chaos. Nvidia quietly filed an 8K with the SEC, carefully avoiding the words quote-unquote profit warning. They admitted that the US ban on selling even their H20 GPUs to China will hit Q1 2025 earnings by a cool $5.5 billion US. Ouch. Nvidia stock tanked to $96 a share after the news. But then retail investors, bless their hearts, jumped in heads first, pushing the stock back to around $135 by now, making Nvidia a $3 trillion company again, rubbing shoulders with Apple and Microsoft. Here is the problem. The fundamentals don't match the hype. Nvidia's not shipping Blackwell GPUs at scale. They stopped taking orders for Hopper chips a while ago, and they have faced big cancellations for Blackwell orders, as was broadly reported even by usually sycophantic mainstream media. Some of those cancellations got flipped into orders for the new Rubin platform. That's nowhere near production, but hey, that's just a detail. It's like selling ticket to a concert that hasn't been scheduled yet, or even more, that you don't even know who is going to play at that concert. Now, let's talk about something fishy. Customs data from Singapore shows a massive spike in semiconductor deliveries to the country in Q1 2025. Nvidia has got a hub there, but everyone knows most of those GPUs aren't staying in Singapore. Then there is Malaysia. Customs data says over 3 billion worth of GPUs landed there in Q1 2025. Malaysia? A country with no real infrastructure for data centers? Come on. My eyebrows shoot up when I saw this. It smells like mislabeling, GPUs tagged for one destination but ending up somewhere else, is gearing up to a whole new level. Investors should be starting to ask why Nvidia and its partners are going to such lengths to hide where their chips are going. But hey, when the bull market is raging, who cares? Perhaps the ultimate sign of reckless behavior on this front, almost as if CEOs of trillion-dollar companies are above the law, was Jensen Huang stating in an interview with Bloomberg he sees no evidence of AI chips diversion to China. Well, as you can see on the screen now, he is undoubtedly and blatantly lying. Now, let's bring super microcomputer, Nvidia's partner in crime, into the picture. On April 29th, SMCI dropped a surprise 8K, calling it quote-unquote preliminary earnings instead of a profit warning, hoping to avoid spooky markets. They didn't manage to accomplish that. In that 8K, they admitted they are slashing revenue forecasts due to commercial headwinds, regulatory scrutiny, and production delays with Nvidia's Blackwell GPUs. Let me remind you, Blackwell GPUs were supposed to start shipping last June, but they are still not rolling out from factories at full speed. SMCI stock crashed to $30 when that 8K shock hit. But because this market is drunk on optimism, retail investors and a blatant short squeeze pushed the price of the stock back to roughly $45 by Friday. During their May 7th earnings call, SMCI's CFO casually mentioned they are ramping up operation in Malaysia. Wait, what? SMCI's production is mostly in Taiwan, and Malaysia is not exactly a tech hub. Something is up, and it risks coordination with Nvidia, which, by the way, gets over 10% of its revenues from SMCI, a client that barely dodged the listing from Nasdaq last year over shady accounting. They were saved by an auditing firm, BDO, notorious for signing off on cookbooks. Red flags, anyone? The cracks in Nvidia's story keep growing. Jefferies estimates that only 1,500 GB200 units were delivered in Q1, way down from the 3,800 they initially projected. Morgan Stanley slashed their COWS manufacturing forecast through 2026 by 25% already. Then there is TSMC, Nvidia's sole chip maker, hiking prices by 10%, and rumors swirled that Nvidia will pass that cost on to calm the markets. Why? Because I eat to Nvidia's 70% plus margin that any rational person know they are obscene and unrealistic, would tank the stock. Q1 2025 was objectively a disaster for Nvidia, plain and simple. The only thing keeping them afloat was the Trump administration scrapping the Biden-era AI diffusion rule, which would have exposed Nvidia's shady supply chain. Let's be real, a lot of those GPUs are ending up in China, despite the bans. And even though I see no problems with that because I'm supportive of free markets, that's a US federal crime. But who's going to call it out? Nvidia is too big, and the AI is too central to this US administration's agenda. Here is the bigger issue. The AI bubbles is on shaky ground. There is a massive glut in data center capacity. Microsoft, Meta, and others are scrapping expansion plans. Without that constant drip of bullish news, it is really tough for semiconductor stocks prices to continue trading at today's absurdly inflated levels. To keep the hype train rolling, Jensen Huang tagged along on Trump's Middle East trip. Surprise, surprise, bullish headlines followed. Nvidia supposedly agreed to ship 18,000 high-end GPUs to Saudi Arabia and signed MOUs to build a massive data center in the desert, potentially housing 1 million GPUs. As I said in part 1, this is nuts. Data centers need cold climates to manage GPU heat. Building one in the desert is a technical and financial nightmare. Plus, where is the demand for all this AI computing in the region? These headlines juiced Nvidia stock. But the narrative is fading and we are still 10 days away from earnings. I won't be shocked if more deals pop up to keep investors distracted. Meanwhile, Nvidia major customers like Alibaba, SoftBank, and Microsoft are still burying the AI revenues within data center revenues, in a sign that the business still isn't generating enough revenue to be presented on its own, despite the tens of billions of dollars of CapEx squandered on GPUs and data center capacity until now. Meta even just delayed its flagship AI model. The data are screaming. This last quarter was rough for Nvidia. Nvidia's 8K from April 15th dodged any real talk about future guidance, especially for high-end GPUs outside China. They might try to paper over the mess with a bigger buyback or some accounting tricks like booking gains from their stake in CoreWave in order to hold back investors from dumping Nvidia shares. Speaking of CoreWave, Nvidia anchored its IPO to keep it from flopping. Nevertheless, CoreWave stock hit $60 despite weak earnings and a debt pile collateralized by collapsing Hopper GPUs, prices turning toxic. It's a house of cards, but the market is too hyped to care. Here is the deal. Nvidia's earnings are going to be bad. If investors stop drinking the AI Kool-Aid, the stock will take a hit. And since Nvidia is a market leader, a stumble could drag down the whole semiconductor sector, the Max 7, and a good chunk of the stock market overall. The AI hype has been propping up this market, and I expect Nvidia management will do all it can to keep it up until June 25, when the company shareholders will be called to vote on their bonuses and compensation. But the reality, oversupply, low barriers to entry to develop AI models, and cutthroat competition is catching up, which results in high costs and limited revenue growth. From the first batch of these AI companies that got their valuation inflated through the moon, but those are completely disconnected from what they are effectively delivering right now, and they are in position to deliver in the future, reasonably speaking. June 25th will be the day of the Nvidia shareholder annual general meeting that this year lands at a tricky time. If there is no progress on trade talks, markets will already be sweating. The US faces $7 trillion in debt financing this year, plus a growing deficit. The China tariff truce ends soon after, and allies like the EU and Japan are playing hardball. If the US goes it alone with tariffs, inflation spikes, markets tank, and the Fed keeps rates high. If they extend the pause, the deficit balloons and inflation creeps up anyway, because they will have to monetize that additional deficit spending, directly or indirectly through other central banks elsewhere continue to printing money. It's a lose-lose situation. The US might, quote-unquote, win the tariff war by strong-arming companies to bring production home, but without allies, it's a lonely fight. Higher costs, supply chain chaos, and pissed-off trading partners could make it a Pyrrhic victory. An eventual Pyrrhic victory that can be overshadowed by a government debt crisis starting from the US, but potentially spreading like wildfire to other troubled countries around the world, especially Japan and the UK, which, as of now, are respectively the first and second largest holders in the world of foreign reserves invested in US government debt. Friday after the bell, when everyone was ready to enjoy their first happy hour drink of the weekend, the rating agency Moody's decided to ruin everyone's party, especially that of the US president, whose plan was to keep everyone's attention focused on all the great achievements, deal, and political results he got during his last tour of the Middle East. Many of these deals really break the sense of logic and pure mathematics, as highlighted in part 1 of this episode, but who cares? Why did Moody's wait until now to follow Standard & Poor's and Fitch and downgrade the US credit rating from AAA to AA1? Did the agency expect Trump to have a magic wand to quickly fix all the economic and financial mess brought to the extreme levels by the Biden administration? Or, reasonably speaking, was the timing of this move planned to politically undermine President Trump? There is no doubt that the agency waited too long to downgrade the US, but there is also not much doubt about the fact that the US can hardly be considered a AAA risk anymore, looking at the state and future outlook of its government finances. Make no mistake though, US T-bills and treasuries will remain the risk-free debt standard across financial markets, regardless of whatever rating they will be assigned. Why? Imagine a building where the whole structure is standing on 4 pillars. US dollar, T-bills, US treasuries, and Fed funds are the 4 pillars of the modern global financial system. Period. A de-dollarization process is likely occurring, but will take years if not decades, and you can be sure the US will fight hard against it, since already a decoupling from China, allowing it to create its own regional financial system based on 4 pillars under its control, will significantly undermine the US economy and influence beyond its borders. What is the market reaction we can reasonably expect on the back of Moody's downgrade decision starting from tomorrow? Everyone familiar with debt and credit knows that this move will trigger a series of downgrades across the board, starting from US agency debt, but potentially on US corporate debt. The biggest development, though, will be on other countries' credit ratings, since Moody's, for consistency, will not be able to ignore the fact that not only the US government debt sustainability is deteriorating, in particular for countries like the UK and Japan, that already had their own serious problem before Moody's decision. One thing I did not see anyone talking about was the potential impact on US Treasury yields as a consequence of Moody's downgrade. What's going to happen to the value of foreign reserves held in US Treasuries if yields increase? The value will go down, and those reserves are the ones that support the nominal value of the national currencies, right? As I said earlier, Japan and the UK are now the 2 largest foreign holders of US debt, and they are about to see a good chunk of their reserves being hit by a blow. These will happen at the same time the 2 countries are actively printing money and constantly engaging in especially monetary operations to support their local economies and bail out their troubled financial system at the same time. Moody's decision will surely prompt many market operators to start putting serious effort now into scrutinizing actions and consequences of many countries and central banks, potentially trying to anticipate moves in yields resulting from more rating actions expected down the road. Everyone should get prepared to see jitters in the yield market, and if these result in pushing yields higher not only because of inflation but because of a perceived higher risk of default, then some countries can quickly find themselves in serious trouble, with the yields of their government debt starting to run loose. Will stocks be able to keep their heads stuck in the sand and ignore all of this? I expect they will try their best to ignore this at the very beginning, especially with Nvidia earnings ahead and US administration engaging in a continuous effort to deliver bullish narrative to markets. However, once the situation escalates, rising yields will start denting the cost of funding of the stock market, that will be forced to acknowledge a deteriorating landscape and resume retracing. For all the reasons I explained many times, I do not expect a market crash that soon. Stocks will likely tumble again, but governments and central banks will try their best to lift everything back up, triggering potentially powerful bear market rallies. However, it is obvious where we are heading in the long term, and I won't stop suggesting to position accordingly in advance, because when things escalate all of a sudden, it's going to be too late to run for the hills. All right, folks, that's it for episode 26. We have peeled back the curtain on Nvidia's quarter and the eye bubble, and discuss about Moody's decision to downgrade US and potential consequences. Around June 25 is the date to watch. Nvidia earnings on the 28th and everything in between the earnings and the annual general meeting could be the match that lights this market fuse, in combination with not positive development on the tariffs front. Thanks for liking and commenting on this video, for subscribing on my YouTube channel, for supporting me on X, and for reading and commenting my article on JustDario.com. I wish everyone an awesome Sunday and a great week ahead.